In this video, we're going to talk about the different types of bonds that a firm or organization could issue to raise capital. So just quickly, what we're talking about with a bond, whatever type of bond you have, we basically have a promise to pay. And you're promising to pay a principal, and you're also promising to pay interest. So you have the principal, you have interest. Now that interest may actually be implicit. You don't actually have interest payments. You might have a deep discounted bond, and that's something we're going to get into. But you always have these two things present. And then you have a lending agreement. You have some covenants, restrictions on what the firm can do with the money. But in any event, let's just get right into the types. So we'll have a secured versus unsecured. It's a very important distinction when we're talking about what type of bond we're dealing with. And by secured, what we're talking about is that the firms pledge some kind of collateral. So if we think about a person for a moment instead of a firm, when we think of a mortgage is basically the person is borrowing money and they're pledging their house as collateral. A house, now a firm or a school district or something like that will pledge assets, right? Machines, any kind of asset that basically the lender could seize, right? So these are things that could be seized if the lender doesn't get its money. If it doesn't get repaid, it can go and take the machines, it can take the warehouse. So basically the borrowing has been secured by assets. It's got assets backing it up in case the person or the firm doesn't pay. Now unsecured, there's no collateral. And you might be thinking, well, why would anyone lend if there's no specific collateral attached? Well, some firms don't have a lot of assets that they could pledge. In that case, what they're really pledging is basically their profit stream, right? Now, that's riskier. So this is riskier for the lender. So what do? Well, they charge a higher interest rate. A higher interest rate to compensate for that risk. And in some cases, there's a really high interest rate because there's a lot of risk, and in those cases, we call it like a junk bond. For example, there were a lot of acquisitions financed in the 1980s with really high interest rates because they were very risky, and they were called junk bonds. So it's basically a high yield. This is a high yield bond. It's not secured by any specific collateral. So this is a very important distinction when we're thinking of what type of bond we're dealing with, whether it's actually backed up by hard assets or whether it's unsecured. And another distinction of bonds is to wonder, okay, well, is this a term bond? Is it a serial bond? Or is it callable? If it's callable or non-callable. Now let me actually talk about this term and serial first. So term is basically the bond has a specific maturity date. Right? So in 5 years, this bond is going to mature, and at that point, the principal needs to be repaid. Let's say it was $1 million of bonds. That $1 million needs to be repaid. That's what we're talking about. Maturity date. There's a specific point in time. Now you might think, well, wait a minute. Don't all bonds have this? Well, that's kind of what we get into with the serial notion. We basically got, so the term bond is there's one maturity date. A serial bond would have multiple maturity dates, multiple dates. And it might be like a school district or something that gets a certain amount of money each year, and so then you say, okay, well, this year a certain amount of this bond is going to come due, and the next year, and we're not talking about interest, we're actually talking about the principal. So it has multiple maturity dates, a serial bond, and a callable bond is actually a little bit more unusual. And the callable, basically, at any point in time, the bond can be called back. What does that mean? It means that they could immediately say, okay, now the bond is due well, basically, you could just say, let's say it's callable at 102. Let's give an example. So at any point in time, they could pay, so let's say the bond was $100. You could pay $102 and say, okay, now there's no more bond. We've called this bond back by paying $102, which is $2 more than the face value, right? Now there is no bond. It's basically been immediately matured. So we'll just say this is immediate upon being called. And we call that a call feature. Does the bond have a call feature? So now another thing to think about is whether there's convertibility of the bonds. Convertibility. And what we're talking about with convertibility is, can the bond be converted or changed into a different type of instrument? So for example, you have a $100 bond, but can that be exchanged for 15 shares of stock, of common stock? Right? So you say, okay, look, I need $100. I'll give you this $100 bond, you tell the lender, and you say at any point in time, if you so desire, you can exchange this bond for 15 shares of common stock. That would be a convertible bond. Not all bonds are like that. This would again be similar to having a call feature on a bond. It could be convertible or non-convertible. Now, another distinction with bonds is that we talked earlier about how every bond has interest. Well, not all have interest payments. The interest is kind of implicit in the bond itself. We call a zero interest bond. Is basically, I'll just give you a quick example. So instead of saying, okay, every 6 months there's going to be interest payments, and you'll have to pay $50 interest or something like that until the bond is mature. Instead of that, what you say is, okay, look, I'll give you $600 today, and you give me $700 next year. And then that's it. That's just it. Or it's just there's no interest payments. As such, the interest is basically implied in this difference of $100. So you're giving the lender is giving out $600, but they're getting $700 back upon maturity. So no periodic interest payments. They're just discounting. They're discounting the face value. Right? So the face value is $700. That's what they're going to get back, but they're saying we'll give you $600, and so that interest is just accounted for in the difference between those two amounts. So that's called a zero interest bond, a deep discounted bond. Another feature of bonds is whether they actually have someone's name on it or not, and that's when we get into the idea of whether a bond is registered or bearer bond. So a registered bond it actually has someone's name. So it's a specific person, right? This is John Doe's bond, specific person. And a bearer bond, it does not have a name. So just anybody, for example, if you remember the movie Die Hard with Bruce Willis, the bad guy was trying to steal hundreds of millions of dollars in bearer bonds. Now that wouldn't have been effective if they were registered bonds because that's in somebody else's name. But a bearer bond is not in anybody's name. So assuming you have the bearer bond, you can go ahead and get the money, even because it's not in anybody's name. So now we can also think about commodity-backed or asset-backed bonds. Commodity-backed. And these are a little bit unusual in that we normally think of a bond being redeemed with cash. Right? There's this maturity date, and you repay the $1,000 or so forth. But commodity-backed can actually be repaid with commodities. So we think of things like gold, silver, oil, these types of things. So someone says, okay, instead of paying you X amount of dollars, I'll give you 20 ounces of gold for each to redeem each bond. So it's basically the bond itself is not backed by cash, or it's not going to be repaid in cash. It actually could be repaid with a commodity.